Hi, INGRoupers. Thanks for coming to our talk on the glass cliff or speed bump, gender diversity in U.S. mutual fund management teams from 1992 to 2016. I'm Natasha Ouslis, and I'm representing our three other co-authors, mostly from the Business School and Department of Psychology at Western University and Dr. Kenneth Goh at Singapore Management University. Let's start off with a bit of an overview of the mutual fund management industry. This industry comprises of finance professionals who choose stocks to invest in their mutual funds, and it's moving towards a team-based model from a predominantly single mutual fund manager approach that they had in the 60s, 70s, and 80s. Starting in around the early 90s, as many other industries did, they started joining people together to create more team-based decision-making as opposed to the individual stars they had before. This was for a few reasons. One, the broader expertise the different team members can bring helped potentially create better investment decisions coming from people who have expertise in energy, mining, technology would help them make better decisions to invest in stocks as opposed to one person who couldn't have the same depth and breadth of knowledge in these different industries. The second reason is more a benefit of the fund families that manage these funds and that decide who goes into the mutual fund management roles. Less of a reliance on star managers, for example, Peter Lynch in the 70s that comes to mind, would help to shift the upper hand to companies because then one star person couldn't take as many clients away from them for threatening the performance of the company that it was managing. Finally, teams can also protect against some decision biases, and so our co-author, Soraya Patel, and other colleagues found that teams can mitigate against performance-induced trading that comes from overconfidence and that leads individual managers to flip their stocks more frequently, actually reducing their performance. This is something avoided in teams, and so it's a benefit as well to move to a team-based structure. Looking at this chart from 1992 to 2016 that comes from the Morningstar Fund database, we can see that the number of funds managed by teams compared to single managers increased over this time, especially increasing as a share of the funds managed overall from 2000 into 2016. However, the mixed gender teams within this sample from 1992 to 2016 again remained very rare, starting off at around 4 to 5% and going up to a max of 20% that stayed flat since the global financial crisis until now. The question here is why mixed gender teams are so rare within this industry and what impact do they have on performance, perhaps explaining why companies are reticent to use them. First of all, our research question is, do mixed gender teams perform differently than single gender, in this sample, all male teams? Second, whether team fault lines on education and experience explain these performance differences. And finally, whether the teams were performing poorly already, and this explained women being added to teams as opposed to only seeing those performance declines after women were added to the team and created a mixed gender team. To start off with the first research question, we did a regression with over 21,000 teams that found mixed gender teams had worse performance on various metrics of fund performance in terms of how well they performed against the market. This found a negative effect that you can see is consistent and significant across these different metrics of coming from the finance industry. The second analysis was a match sample analysis that would be a little bit better at determining causation. And with over 12,000 teams, we found that mixed gender teams still had worse performance on these metrics, and it was consistent across these different types of analysis. Both analyses controlled in different ways for these metrics about the fund, the turnover ratio, the fees, the size of these funds, the flows, and it might be cut off there, the average industry tenure of the managers. Looking now to understand why this is happening, we thought that team fault lines might explain the differences in performance. Here you see an example of a team fault line where the one woman on this mixed gender team has less industry experience than her male colleagues and comes from a less prestigious or highly ranked school. This could lead to rifts in the team that we know can be detrimental to performance and information sharing. However, fault lines didn't have any significant interaction with the all male or mixed gender identity of the team in terms of its impact on team performance. There's a lot of different reasons this might be true, given the missing data and balanced sample and the challenges in computing an accurate measure of the fault lines for this group, but we believe that this doesn't explain the finding that we found in research question number 1. To look instead at what the previous performance was, we could see that women were added more often to worse performing teams in the past 3 years than better performing teams. And this was found in a matched sample analysis where we controlled for the size, age, fees, and turnover ratio, and others that I mentioned before. And you can see that the result is consistent across controlling for these and just in the matched sample. This suggests that women are more likely to be added to low-performing teams, which can explain some differences in the future performance of those mixed-gender teams. In terms of how this is happening, though, and what exactly is the mechanism, this is where the glass cliff speed bump kind of analogy comes into play. So this selection effect could be driven by a classic glass cliff phenomenon where hiring managers are choosing women for these worst performing teams, hoping to turn it around with the guidance of women who are going to clean up the situation. But the other theory on the side is that this is a queuing effect that could come from male fund managers lining up for those higher performing teams and not leaving any good teams left over for the women in the industry. This would really be driven by different people's decisions within this team composition and selection process, and future research that can answer questions about how these teams are composed and what exactly are the steps in that selection can explain why mixed gender teams underperform in this industry. What we know right now is that there is a speed bump, at least, that's slowing down women's progression in these fields, and that the low performance that we see before they've even joined the team can be a real indicator of that speed bump really slowing down women's performance. Thanks so much for your thoughts, and looking forward to any questions and comments you have. Thanks.